It's time now for today's strategy session. Today's CPI report sending stocks higher as investors breathing a sigh of relief on the inflation front. So could this print be the catalyst for the next leg higher in stocks? Let's talk about that and more with Kevin Mahn. He's Hennion Walsh, Chief Investment Officer. Kevin, it's great to have you back here on Yahoo Finance. So what do you think? How big of a catalyst do you expect this print to be here for the market?
Yeah, Shawna, I believe that the beginning stages of the new year are likely a microcosm for what 2025 overall will look like for the markets. More uncertainty, more short-term bouts of volatility, changes in leadership, but ultimately more growth opportunities ahead. However, investors need to be realistic about their expectations for overall stock market gains. And here's a great stat for all of your listeners. Going back to 1950, Shawna, there have been 9 times where the stock market has rallied by 20% or more in consecutive years. 2024 was the 10th time. Good news is that in 8 of those 9 times, the stock market was higher the following year. Perhaps the bad news, only by an average gain of 3.6%. So investors are going to need to be a lot more selective in the new year to find those growth opportunities, and Jared touched upon a few of them. Smaller cap biotech, smaller cap regional banks, and then leaning back into the AI revolution because that's a long road ahead and there's plenty more growth opportunities within the overall AI ecosystem.
I think both of us were sitting on set, Kevin, hearing that and just like, dang, all right, that's some serious cold water. Only 3% on average after those 2 consecutive years of 20% gains here. So ultimately, what kind of chop, perhaps, what kind of volatility then should we expect, even if we were going to see even 3% or more type of growth in the S&P 500?
Yeah, Brad, last year was an abnormal year for volatility. If you look overall, the number of days where the stock market declined by 1.5% or more was less than 4% of the time. So investors should anticipate that low a level of downside volatility. And we're going to continue to play the Fed guessing game. Now we've had 2 positive inflation reports. We had a positive, or actually a hot jobs report last Friday. So I think the Fed does nothing in January. They don't meet in February, and there's a high likelihood that they don't do anything in March either. So no interest rate cuts, certainly no interest rate increases during the first quarter of the year. That will call investors into question, well, when are they going to cut next? And when there'll be a return of inflation? So that could introduce some choppiness. And we can't just necessarily throw a dart this year at the S&P 500 dartboard and expect to get a gain. You're going to have to actually search for some of those growth opportunities, but I believe there are numerous growth opportunities ahead.
Kevin, where are they?
Well, the first place I would start is in the AI revolution. When I talk about that, everyone wants to go into semiconductors and chips and NVIDIA and Broadcom, and certainly there's more growth opportunities there, Shawna. But we need to look beyond that as well. Look into the software companies, the hardware companies, and at the top of that chart right there, data centers, which you generally find in the real estate investment trust category, or REITs. Consider companies such as Digital Realty, Equinix, even Iron Mountain. But as we continue to find more and more, these data centers require tremendous amounts of electricity, and they run very hot. So that introduces the cooling solutions from companies such as Vertiv or Modine Manufacturing, and of course the utilities that supply all that power to them, whether it's natural gas, electricity, or now, as we're finding out, nuclear. So I think that's one area that's ripe for investment opportunity, and then jumping into, of course, again, the biotechs and the regional banks as well, Shawna.
Kevin, coming off of the CPI print for December that we've been breaking down throughout the morning, it seems like there's more of a tenor that the Fed could be in wait-and-see mode after the inauguration, of course, waiting for future data prints as well, just to see how policy changes might be ingested by the economy. Where are the opportunities, and which sectors do you think are best positioned to benefit, perhaps, from a pause from the Fed?
Sure. And one thing we need to keep in mind, as of December, according to the Fed's dot plot chart, they're only predicting 2 rate cuts of 25 basis points each this year. In total, another 2 rate cuts of 25 basis points each in 2026, and just 1 rate cut of 25 basis points in 2027. In fact, by their own inflation gauge, they don't believe that core PCE will get to 2.2%, still above their 2% target, until the end of 2026. So I think that Fed path forward for lower interest rates is going to be very gradual, and investors shouldn't expect much more. So look for those companies within those sectors that pay good dividends, that have strong balance sheets, and can weather a potential economic slowdowns. Don't forget about consumer staples. Look to some consumer discretionary names that allow the consumer to be more frugal. How about a name like Amazon that continues to dominate the e-commerce world? And then as interest rates do gradually move lower, expect more M&A activity. And that's where the smaller cap biotechs and the smaller cap regional banks come into play, Brett.
Kevin, how close are you watching, just in terms of what's going to be the biggest driver of the market this year? Is it the Fed moves? Is it the latest reading on inflation and jobs and the assessment there? Or is it earnings? And I bring that up just because some of the talk this morning is on the heels of that softer than expected inflation print. Maybe the focus is on earnings, and that is going to be enough here to be that next catalyst higher for markets.
Yeah, Shona, the markets are still trading at elevated multiples above both their 5 and 10-year averages. So what helps bring down those multiples? Increases in earnings, or on the flip side, decreases in price, but no investors like that. So we want earnings to grow, and we want that earnings momentum to extend beyond the Mag 7 into the not so magnificent other 493 stocks. Fortunately, as it's forecasted now, they're expected S&P earnings growth of about 15%. Perhaps if inflation continues to stay moderate and we get a couple of interest rate cuts from the Federal Reserve and the economy doesn't slow too much, we could see even more earnings growth, and that would make opportunities in the stock market even more attractive. So yes, I'm going to be watching GDP growth. I'm going to be watching the inflation prints, and then of course the unknown. If in fact tariffs will be put into place, what will the retaliatory tariffs look like, and will they have an inflation consequence themselves?